O nosso próximo painel é sobre uma região que está cada vez mais importante quando a gente fala sobre investimentos globais. Uma região que representa hoje 60% da população mundial, tem tido um dos crescimentos mais rápidos do mundo e é um importante polo de inovação e tecnologia. O painel de agora vai falar sobre Ásia, Ascensão e Oportunidades. I would like to welcome Brendan Ahern, CIO of Crane, and Joe Na, CIO of Mirai, with the online participation. E para moderar esse painel, gostaria de convidar o João Scandiuzzi, sócio do BTG Pactual.
So, good evening, Joe. Thank you for joining us from Hong Kong. Thank you, Brandon, for being here in Brazil. So, I'm very excited to host this panel. I think it's a very exciting part of the world, Asia. A lot going on, of course, emerging very rapidly, and therefore many investment opportunities as well. So, I'd like to start with you, Joe, maybe talking about the dynamics of the Chinese equity markets in particular. We have had very difficult years, especially from 2021 to early this year. Then from February to May, we had seen a very decent rally in equity markets in China. And of course, I think there are many questions that pertain to this. First of all, of course, I mean, do you see this rally, this recent rally, as something that is that has legs that can continue going forward? What kind of investors have participated in this rally? What kind of sectors have really shined? What others have lagged behind? So let's start with you on this issue.
Okay, so the recent rally was mainly driven by foreign inflow through Hong Kong listed shares. So if I compare the performance of the H share versus the Shanghai A share, then H share went up almost 14% year to date, while Shanghai A share was only 1% for the same period. The reason for this difference is not so much about different views between foreigners and the mainland investors. It's more because the H share declined about 46% for the previous 3 years, I mean, from 21 to 24. And while on the other hand, A share declined only 11% over the same period. So late last year, most regional and global funds had huge underweight positions in China, but many of them, including us, started to reduce underweight position in China early this year with some stabilizing signs in China macro. That was kind of the source of the inflow. And then regarding the question then whether this rally is going to be sustainable, I would say our view is more open to the upside potential than downside risks from here. However, the recent rally was mainly driven by re-rating. So valuation re-rating rather than earnings upgrades. It's if you look at the MSCI China, that 12 months forward PE reached almost 8 times in January, and now back to double digits at 10 times already. So from here, investors need to see more support in the earnings cycle, earnings revision. So we think we are in that direction, but the trajectory will be more bumpy with the ups and downs, and rather than this linear path. But again, we are more positive for the upside potential, although the pace of market rally may be slower than what we saw early this year.
Okay, maybe a follow-up question here, but I think many investors question if the Chinese equity market can continue to rally without a bottoming out of the real estate sector, which is, of course, in a very dire situation. How do you see this issue?
The property sector, so it's very important. And then if you look at the domestic demand versus an external demand, so if you look at the last 3 years, actually it was mostly driven by external demand. And then some people criticize why the Chinese government is not pushing and then stimulating the property sector and the domestic demand more aggressively. because the reason, even like the property policy, which was released on May 17, only the amount they support to clear the inventory was 300 billion RMB, which is not enough to clear the inventory at all. So it was a bit disappointing to the market. But I think it seems like the Chinese government, they are saving some bullets to more aggressively support domestic demand when they see, for the time when they start to see some weakening signs of external demand. So far, they set the growth target of 5% this year, and then just May data came out a few days ago. Then it looks like it was not possibly surprising at all, but it looks like it's 5% of a growth target can be achievable. So they don't need to use their bullets at this moment. So I think now already we saw some weakening signs in macro in the US in the last week. And then now the expectations for the Fed pivot. So I think investors, they are expecting some weakening trend of external demand where the China has been relying on a lot so far in recent years. So I think maybe when we are going to kind of later stage of this year, I think the government is going to deploy a little more aggressive policy to support the property market to rely more on domestic demand from the time.
Brandon, turning to you, you have just returned from Hong Kong. I'd like to know what's on the ground feeling there, especially compared to your previous visit to Hong Kong.
First and foremost, it's great to be in this beautiful city that you call home. This is my first time to São Paulo, but I know it won't be my last. I'm going home a little bit heavier to all the good food, but we cross-listed our largest flagship fund. KWEB is our China Internet ETF. It's the second largest China ETF outside of China. We listed with the help of BTG Pactual on the B3 yesterday. So I'm really looking forward to coming back. But I think what's really important for investors is, one, to understand that there's been a big change in China from when I was there in December. It was muy malo, or muito mal. Sentiment was very, very poor. And things are coming back. And I think what's key is that, one, there are catalysts coming. That if you look out on the horizon, we just had JD.com's and Alibaba's big 618 sales event yesterday. Very, very strong numbers. Online video game company called Bilibili got upgraded. Went up 18% yesterday that we're invested in. But we have next month in July, the third plenum. So Xi and the top 200 leaders in China are going to get together to forge economic policy. In August, we have the KWEB companies, the internet companies, report earnings. China GDP in first quarter was up 5.2%. Online retail sales is up 12% year over year. So in September, we have another catalyst with potentially Alibaba becoming available to investors in China, Southbound Stock Connect for the first time. So there's actually some really positives, and I think it's against a backdrop of really low or non-existent ownership of Chinese equities. That the last few years have pushed investors out of the stocks. And I think here in Brazil, has Brazil exported more or less to China over the last 1 year, 3 years, 5 years, 10 years? Is Brazil sending more or less soybeans, iron ore, crude oil to China? It's up, but the stock market has gone down, down, down. And I think some of that is just US stocks are up. S&P 500 is up almost 1,000% over the last 15 years. And all country world ex-US is up 300. And EM and China are less. So 15 years is 60 investment committee meetings, board meetings, trustee meetings about explaining why do you hold these non-US equities that always underperform. And for many investors, the only thing they own is the S&P 500 because nothing else works. And on Monday, Bank of America put out their fund manager survey. Did anyone see this? The largest trade globally is Mag 7, Magnificent 7, no surprise, but it's 69%. It's professional investors' largest position. That's the highest number of any overweight in the history of the survey. And number 2 is short China. So my counsel, why I'm so excited about our cross-listing here in Brazil is because it's a good time to take a little piece, just a little piece of US profits, India profits, put it in cheap China. And we do think there's all these catalysts happening. It's just not necessarily front page news, but we think there's a lot of positives coming, and just investors are very underweight at the moment.
Joe-hee, how vulnerable do you think Asian markets in general are to geopolitical risk? And especially, let's consider, the upcoming US elections, of course, especially China, but not only China is a big issue there in terms of protectionism and other policies. So how do you see Asian markets positioned to this potential risk, and what are the opportunities as well?
Yeah, there are two kinds of geopolitical risks. One is from the Middle East, and the more important one is from the US and China tension. So the overall impact of oil price hike, potentially driven by geopolitical risks in the Middle East, is relatively lower in Asia compared to the past, as the two largest oil consumers in Asia, China and India, now continue to be able to buy cheaper oil from Russia, in a sense. But more important geopolitical risk and issues that we will face in Asia as an investor will be the US and China tension, which could be heightened around the US election. So market seems to be already actually discounting some part of what we heard from the Trump camp, such as a 60% tariff on Chinese products. So we don't really expect the Chinese currency to depreciate over 10% from here, like we saw in the first trade war. However, China's vulnerability is more linked to its weak domestic demand. So because, as I mentioned earlier, China's dependence on export has grown in recent years in its economic growth. So if the benefit they get from this external demand, very strong external demand, gets to reduce due to any conflicts with the US, then they need to see the improvement in domestic demand to offset that negative impact. But until now, I think that the Chinese government, in my opinion, they are just saving the bullets. So I think around this election, maybe the market volatility will be heightened, will be higher, but I think that magnitude of the Chinese yuan move, or the market kind of the negative or the move, that relative magnitude, I do not think it's going to be beyond expectations at this moment, because already some of that is being discounted in the market. And then on the other hand, in terms of opportunity, we see opportunities in India or Vietnam, especially as a beneficiary of China Plus One strategy. So maybe you can talk about more details about those in the more emerging markets. But I think non-Chinese, some of the non-Chinese countries, they are positioned to benefit out of it.
Okay. Brendan, your firm just held a webinar about U.S.-China relations. So what's your take on this issue and the risks and opportunities?
Yeah, we're very friends with Terry Branstad, who was President Trump's ambassador to China, as well as our general counsel, David Edelman, was President Obama's ambassador to Singapore. So we had a webinar, which we'll share with yourself and your clients, if in there, where what happens if Trump wins, what happens to Biden? Okay, so here, Trump is a business person and he's anti-war. And I think China would rather deal with Trump because they can do a deal with Trump. And Trump says crazy stuff, like 60% tariffs, But if you think he's going to do 60% tariffs, you should short Costco, Walmart, Amazon, and Home Depot, because those 4 companies are in deep trouble. But that's because it's not true. He's just playing to his audience. And with Trump, you have to take reality and rhetoric as they're not the same. You know, so Trump has a lot of bark, but not a lot of bite. But he's a business person, and he talks to business people, like Elon Musk. You think Elon Musk is telling Trump about his factory in Shanghai, how much money he makes there? Or when he meets with Tim Cook, or Boeing, Nike, ExxonMobil? So I think for China, Trump is actually better. At the same time, Biden has been worse for China than Trump, because he can't be soft. He can't be weak to China. So he's been very tough. But for both candidates, it's their second term, so it's about their legacy. And I think you could see a change with Biden in trying to do a deal with China, because he would no longer face a GOP threat. So it's not consensus, but we think actually Trump would actually be better for China, because he'll do a deal, and the Chinese will do a deal. And I think, you know, you're seeing here in Brazil some of this nearshoring. You know, BYD is building a factory here in China. That the view from the U.S. is supply chain problems is a China problem. But if you're a Chinese company, you have a revenue problem if you can't get your stuff from China to your clients, like the US and Europe. So the China plus one strategy is driven by Chinese companies, and you see this right here in Brazil with BYD. They're building a factory, comes online later on this year. So some of the nearshoring, it's rhetoric. It plays to these 8 swing states that matter in the election, but it's a lot of noise, in my opinion. It's not, you know, so yeah, we're actually less worried. And the number one pushback from investors when I say, you know, please buy just a little piece of cheap China. They say, what about Trump's gonna win? I'm like, maybe you shouldn't worry about Trump. Maybe you should want Trump. And so I think the macro is the number one pushback I get. But I think it's it's a known risk, but it's also maybe undervalued.
Well, Johi, you mentioned India and Vietnam as interesting markets. Some investors question that maybe they are overvalued in complete contrast to China. So how do you see this issue? And also investors tend to see other emerging Asia ex-China markets as maybe a China play. Do you agree with that, or a more a global play?
Oh. First of all, we are positive on those markets, although there are some valuation issues. I'm concerned. But for India, first, its valuation it is expensive, but it has been always expensive compared to the other emerging markets, because we believe that our approach to India must be much longer than that to other countries, because its population is already ahead of China with 1.4 billion, but its market penetrations are much lower, even in necessity-related products, significantly low, much lower than the other emerging ASEAN countries. So the high quality and the leading companies with very capable management, they are set to enjoy more structural earnings growth for a longer period of time, without with much less, I would say, less volatility of the businesses. So as the penetration rises, and also due to this very huge population, just 1 or 2% of penetration growth means a lot to those individual companies. And also on macroeconomic front, it is almost in a sweet spot, entering into a virtuous cycle through several the major reforms. In the last 7 or 8 years, India successfully included most of the population in their modern financial and social system. And then the efficiency of the policies and businesses have been improving, and to improve further more substantially. So on top of that, the external environment is helping India as well as a beneficiary of supply chain diversification strategies of the global companies. So if you look at the valuation only, then it looks more expensive. But if you look at the earnings revision trend, then actually India is one of only very few countries that still show the positive earnings revision this year. So we don't expect further re-rating or more premium versus other emerging market from here, but continuing earnings upgrade and improving the quality of the companies and economies can justify the valuation premium. And then the Vietnam market as well, this is also one of the biggest beneficiary of this supply chain diversification trend. Actually, in terms of the impact to their own GDP, this is bigger than India. So because it's located right next to and actually right below China, and also in terms of the number of the trade agreements, it is one of the highest in Asia. And also the valuation is mid-teens, about 13 or 14 times, if you look at the 12-month forward PE. Then although last year was a kind of big drop in earnings growth, but from this year till next 3 or 4 years, actually year-on-year growth is about 30 to 40%. So the current valuation is not so demanding, in my opinion. And another catalyst for Vietnam market is currently it's classified as a frontier market, but it is expected to be upgraded to emerging market soon, probably next some market participants expect it actually next year. So it's very soon. So that will be another catalyst. So we are positive on this market.
Brandon, as an observer of Chinese economy and markets, what have you noticed that has changed from the Chinese side over the past few years?
I think in January, the vice chairman of the CSRC, which is China's SCC, visited New York, and in meeting with him, he said, it was his first time back in New York since COVID, and he said, being back in New York, you Americans you're very direct. You say exactly what you think, but in China, culturally, we're indirect. We don't tell you exactly what we think. You have to, and he used this term subtle signs to indicate a change in the tone and tenor of the Chinese government and President Xi to foreign investors and foreign corporations. That Xi going to Biden in San Francisco is almost like an admission of failure. That he went to him. He needs Biden more than Biden needs him. And at the APAC meetings, they agreed to the military speaking, and just last week, the heads of defense met for the first time in Singapore. They agreed to stopping fentanyl precursors. But China has done a whole host of market-friendly, shareholder-friendly moves to the US. And I think that's something that doesn't get a lot of news, but we see this, and then I would say actually also in San Francisco, Xi met with business executives. He had a dinner for business executives. And he didn't have to do that. Why would he do that? But he said, China is open for business, please come. In China, Xi went to a BASF petrochemical plant, a foreign-owned plant. He then went to Shanghai. Even with this upcoming third plenum meeting, Xi said there will be significant measures. So I think Xi has changed the tone and tenor, and I don't think investors have really recognized that. The Chinese are sending pandas to San Francisco and San Diego, but also Washington, D.C. That's a strong sign. I think the other thing that the Chinese government is doing is encouraging the publicly traded companies to be more shareholder friendly. And I think we've really noticed that the companies we hold in our internet strategy in K-Web, the founder is the CEO. And why, if the media thinks China's economy is going off a cliff, why are all of these companies buying back stock? If China's economy or the Chinese companies' prospects were so bad, wouldn't they hoard cash? But Alibaba, Tencent, JD, Meituan, Kuashu, they're all buying back stock. And that's part of the reason is because the founder is the CEO or chairman, right? You know, Tencent, Pony Ma, founder, chairman. Joe Tsai, Eddie Wu, co-founders of Alibaba, chairman and CEO. Richard Liu, founder of JD, CEO. Robin Li, founder of Baidu. And they're all buying back their stock. The shareholder yield, I use Bloomberg, but do 10 cents, 700 HK, equity BBK. You almost have double-digit buyback yields in all of these companies. So they're signaling that they think their stock is cheap. And so we think it's a really, really strong sign for the companies we hold that these reforms are happening. And again, no one owns Chinese equities anymore. You know, they've all been pushed out or sold, or they just own U.S. stocks now. Magnificent Seven. So they've not noticed this, but we're really constructive on the space, and we think this rally is pulled back, and there's an opportunity to take a small piece of your profits into the space.
Joe-hee, how do you see this scenario in the U.S. of high for long in terms of interest rates and also a strong dollar playing out in the Asian markets? What are the implications for your region?
The higher rates and strong US dollar are taken as negative factors for Asian economies and markets in general, especially since we witnessed the region's huge volatility to cross-border capital flows during Asian crisis in 1990s. However, the economic fundamentals of most Asian economies have improved dramatically since then, after they learned lots of lessons. So for example, even when the pandemic broke out, most countries were able to finance their fiscal deficits comfortably without throwing down the reserves, thanks to enough domestic financial savings. Some export-driven countries even built up their reserves. So the higher rate and the strong dollar are still negative, but the risks are generally manageable compared to the past. I think the current issue is more about this. So Asian inflation has fallen, and also real interest rates are high. So credit growth gets weaker, but most Asian central banks cannot cut rates until the Fed starts to ease because of the potential risk of capital outflows. So for example, today, the Indonesian central bank left the policy rate unchanged to support the rupiah stability, their currency, and foreign capital inflow. And actually in April, it surprised the market by even they even hiked the rate to stabilize the currency. But actually the rupiah continued to weaken, and the equity market started to react negatively. So still, there are some a negative reaction in the market, in currencies, because of those kind of issues. But however, we think this will be temporary. The current account deficit, for example, in Indonesia, because usually, Indonesia is taken as one of the example in terms of the currency volatility, and also that they are also the export-driven for the commodities as well. So especially for Indonesia, for example, its current account deficit has improved to almost 0 to only 0.5% to GDP in recent years, from below -3% 10 years ago. And we do not think it will go back to the old times level, thanks to the government's effort, very successful effort to build electric vehicle and nickel downstream industries for the last 10 years very well. And then FDI flow also continued to increase and doubled the size, actually last 10 years. So actually one of the main contributors for that, increasing FDI is China, who continue to invest in metal downstream auto-related sectors in Indonesia. So we appreciate this huge improvement in Asian economies' fundamentals. So as an equity investor, we would use this market volatility as a good buying opportunity for quality companies in these markets.
Okay. Regarding the emergence of AI, what's your perception, Johi, with the impacts on the Asian economies and markets as well?
AI. So we have to, I think we can think of the two different phases. So first, we are still in the AI investment phase. So the countries that play important roles in building AI infrastructure or making chips or cloud services, those countries are benefiting. So in Asia, we can find those companies mostly in Taiwan and Korea, where we expect to see continuing the upgrade of earnings estimates driven by rising contributions from AI-related products. And then the second phase is AI application phase. So we think that the overall impact on emerging Asian countries will be positive, I think. So even more emerging countries tend to have younger demographics. So the adoption pace of AI functions will be faster. So usually, compared to the older generation, actually younger, people, they are faster in adopting the new technologies. So that means the low-cost opportunities for education or healthcare or other social infrastructure will likely increase. That means the pace of financial or social inclusion of low-income people will be accelerated, and the productivity will be improved much faster as well. So for example, we expect India to benefit substantially from applying AI functions on high value-added service export. So India's service export has been very successfully boosted, driven by GCC, that's a Global Capability Center, kind of new scheme driven by the government, which is already about the overall, the service export is already about 10% of its GDP. So that service, it's kind of a GCC, that service export is like kind of outsourcing highly educated and English-speaking human resources from the global company's perspective in India, especially for the high value-added services such as engineering, R&D, or law or accounting, not just call center. So I think if we just combine the AI functions on that kind of very high value-added industry, then I think it will be very helpful to accelerate that service export. And on the other hand, there are some countries where we see, like as much less prepared for the AI, development, or even, we expect some negative impact on their GDP or economic growth or job market, which is one of the example is the Philippines. So, for example, in Philippines, about 10% of GDP is from BPO business. That's so-called, the call center business for global companies. And the characteristic of this work is it's very different from the GCC that I just mentioned in India. So this is very kind of simple, and then very kind of the repetition of the similar kind of the word or conversations. So I think it's easily it can be replaced by AI. So I think the Philippines kind of negative position to have some impact from AI. Then lastly, China. China is building its own AI functions and infrastructure for their own country, despite all the sanctions and ban on technology side from the US. China is currently actually leading the region in terms of AI innovation and regulation. So the development pace may be slower than what we saw in smartphone penetration era, but we all know that from 2011-12, when the smartphone started to penetrate into in China. China was one of the fastest country who can edit all the kind of the value-added functions on that. So they kind of made the whole economy and the market very much online. But I think the pace will be much slower because of all the sanctions and then some bans. But I think we believe that they will remain in leading position in that region, in this Asian region, in terms of the AI respect. Yeah.
Brandon, at Crane, you have a lot of focus, of course, on technology. Do you see China as able to rival the US in terms of technology? Of course, the technology is one of the most brilliant sectors in the US. It's shining, it's driving returns. Can you see this happening in China as well?
Yeah, I think business people get along just fine with one another. We get on airplanes, we eat together and talk, and the diplomats have been not doing as good of a job as the corporate world, which is, I think, unfortunate. But I think that is slowly improving. So I don't see it as this black and white, that U.S. wins means China loses, or Europe loses, or Brazil loses. Like, we can all win, and I think we've all benefited from technology, if it's ASML in the Netherlands or TSMC in Taiwan or Apple in the US, right? Like, we're all beneficiaries of this. At the same time, the US policy has arguably only made China stronger. A few years ago, the US government cut Huawei off from basically all US technology. So Huawei had a choice: go bankrupt or figure it out. And they figured it out, and they created a phone that's actually better than an iPhone. The ProMate 60 Plus is a better phone than an iPhone, thanks to the US government. So I think some of the politicians, they like to get in front of TV and say things, but they're not playing chess. They're playing for these short-term polls. So I think China will only grow. I think similar to Asia, but similar to here in Brazil. And I think the business people need to have a greater voice in Washington D.C. And meeting with politicians in Washington, they are very different when you meet them one-on-one. Usually when I go to Washington D.C., I have to buy them lunch. But then these people who are so anti-China, when you meet them face to face, they say, oh, no, the US and China are very intertwined. We have to be very careful. But they want to get on TV and create a brand for themselves and look important. But many of them know that the US and China are highly intertwined. And the greatest example of this is ByteDance, right? TikTok. So I went down to Washington, D.C., and I met these politicians. And one of them is the one that's basically pushed to ban TikTok. And I said, the state you're from has all these endowments. You have all these universities. And isn't it kind of interesting, like, who owns ByteDance? Who owns TikTok? And they said, well, the Chinese do. And I was like, no. 3 of the 5 board members are Americans. US private equity owns TikTok. And these politicians are saying, oh, ban TikTok. I said, aren't you going to find out which of the universities in your state own TikTok through these US private equity firms? And they were like, well, it's probably going to get challenged in court. And because of the First Amendment, it'll lose, right? The TikTok, they've tried to ban it twice, and it goes to the court, and because of the First Amendment free speech, they lose. So I was like, so basically you're just doing this to get on TV and look really important. Like, we're banning TikTok, even though they know, because if they actually banned it, they'd actually look like really dumb, because they'd hurt their own universities, their own endowments, but it gets them on TV. So in Washington, I think the greatest lesson I've had to teach, particularly in Asia, where in Asia people, if a leader says something, it happens. And in the US, you have to realize some of this kabuki theater, I call it, some of this showmanship, but the rhetoric is not reality, that money does count in Washington, D.C., and it doesn't get a lot of news coverage, but a lot of the rhetoric we see around China, I think, is just that. It's just noise. And I can tell you, like, from dealing with a lot of these politicians that you see as very anti-China, they're very different, because whenever I go meet them, I tell them, oh, you're from Tennessee, your largest company, your largest employer is a company called FedEx. What percentage of FedEx revenue comes out of China? Oh, you're from Wisconsin. Johnson Controls up in Milwaukee employs 100,000 people. 20% of their $20 billion in revenue is in China. Like, who are you hurting? So this, you have to disconnect from some of this showmanship, which I think in Brazil you know a little bit about with some of the politicals. But
no, excellent. Joe-hee, Janet Yellen recently has pointed fingers at China for overcapacity in some industries, including, of course, electric vehicles, batteries, solar panels, things like that. How do you see this issue playing out in the Asian markets? Are there many opportunities in terms of concentration of markets, merger and acquisitions? How does it play in your books?
Yeah, so overcapacity issue has been kind of a long headache in China, so it's not just the recent one. But previous peak of overcapacity issues in China was around 2014 and 2015. But the government used at the time, they used the more administrative means to reduce capacity in 2016. So they kind of, just forced the factories and companies to shut down. At the time, because of the important reason was that the overcapacity was concentrated in the resources sector, such as coal, cement, and steel, with a high proportion of central SOEs and kind of a low degree of marketization. So the policy had a strong intervention ability back then. But now, the current issues Yellen warned are mainly about renewables, just like you mentioned, the electric vehicles and battery sectors that are high value added and play a key role in energy transition and security in most major countries. So we witnessed the demand surge across major markets dating back to 2020, actually. So that was the key driver why the companies, lots of Chinese companies, were motivated to add more and more capacity. Anyway, so the supply increased faster than demand, so now we are seeing the overcapacity. But Chinese companies have cut, before that, so I just wanted to emphasize this overcapacity issue is a bit different from the previous one. And then Chinese companies have cut actually CapEx significantly since 2022 already, but also the Chinese government posted policies this year to uplift technology requirements to phase out low-end capacity and avoid over-competition. We are going to see more M&As taking place in the next few years, especially small companies that hold cutting-edge technologies will be acquired by leading companies like that. So, in conclusion, we remain actually positive on long-term demand outlook. So, not at this moment as investment opportunities, but eventually, I think the technology and cost-leading companies will likely benefit from consolidation going forward. So, at some point, we are going to, if you see some more attractive, kind of valuation for that kind of, very high technology having with a, big, economic scale, so that they can, keep reducing the cost. And I think we are still positive on those market in the those companies in the long term.
Okay, thank you. Do you have time for my last one? Okay, so one maybe for you, Brandon. How do you see the issue of aging? I mean, China is aging very rapidly, following the footsteps of Japan and Korea. What are the implications for the Chinese markets going forward?
Yeah, it's, in one just big picture, the whole world is aging, including myself, unfortunately. But I always use, the country in the worst shape demographically is actually South Korea. Its birth rate is down to 0.8. Additionally, South Korea, unfortunately, has the highest suicide rate globally. Remember the movie Parasite? That one South Korean movie? The lead actor who won the Academy Award killed himself. And so South Korea has a very, very bad problem. It's combining these two, very low birth rate, very high suicide rate. And yet Samsung is one of the best performing stocks over the last 20 years. Would you not hold Samsung because South Korea, Japan peaked population-wise over 10 years ago. The population is down from, I think, about 125 million to 123. Would you not have held Japanese stocks over the last few years? So China is somewhat insulated from demographics from the perspective that, like Japan and like South Korea, as an export-driven manufacturer, it's more about what are the demographics of the countries they're exporting to, which is the US, Europe, Southeast Asia. So it's not like a turn the light off situation. It's a very slow trend. For China, what's key is there's one person who knows that China has a demographic problem, and that's the Chinese government. That last spring, they were so worried about the census, they delayed its release. So China will come up with a solution. I mean, we all know what the solution is. But China's government is going to create solutions to incentivize parents to have, I think it's housing is the key. That China doesn't have suburbs. So people live in a 2-bedroom apartment. Like myself, if you have a bunch of kids, you don't want to live in a 2-bedroom apartment with a bunch of kids. So housing is the solution for China's problem, and they'll come to that solution, and they will address it. It's out there for sure.
Okay. Well, thank you. Unfortunately, our time is out, but thank you, Joe-hee, for joining us from Hong Kong. Thank you, Brandon, for coming.
Thank you.
Thank you all.
Yeah, thank you so much.
Thank you.